Okay, in this option strategy, this is going to be a covered call. And like the protective put, we are going to own a contract of some option for an underlying asset, plus we're going to buy the stock itself. So it's similar in that regard. But instead of purchasing the option contract like the protective put, we purchase the put, we're going to sell the call. So let's get into our model. Let's look at the strategy on the covered call is neutral to moderately bullish on the underlying asset, expecting a slight price appreciation. That's what you're betting on. It's not going to skyrocket up because you'll see it's going to be capped, but you believe in a slight price appreciation. The construction is buying the stock and selling the call. The upside is limited to the premium received for the calls plus any capital gains up to the strike price. That's important. The downside, though, is substantial, equivalent to holding the stock. If the stock's price falls significantly, losses on the stock position can outweigh the premium received. But you do have a cushion to your losses in a covered call. So let's get into the model. Like all the models for these option contracts, what we're going to do is we're going to put a current stock price. We'll say 100. Now let's put a strike price. I'm going to put an out of the money. It's $100 now, but we have a right for the call. You have a right to buy for 105. That's out of the money, but we're going to sell the contract. We want to know what it's going to cost. This is the cost of the contract. We're going to say 10 for the premium. And now we have a current spot price of 100, and I want to do increments of 5% up and down up to a total of 30. And again, with all my models, you can put in 10 if you want a higher scale. You could do 20, but just to let you know, it is continuous compounding, so you'll see your graphs look like it's going to be increasing at a greater rate than a straight line. So we got our range, and now what we want to do is we want to plug in our values to see what our profit loss will be. We have the stock itself. We're going to long the stock, which means we're going to purchase it. So I like to do the stock at the spot price today, so you kind of get a good idea what your profit loss. Well, it's going to be whatever the range is today. It's whatever the value is today minus the price you paid for it. I'm going to hit a function F4. I want to make that an absolute reference. So if I drag this up or down, that will not change. So if it goes down to 95, be 95 minus 100, we lose 5. And this is going to show our profit loss. If it goes up to 135, that means we made 35. And again, if you do the equation one time, I can go down and then hit Control D and it drags it down. It fills down. I want to go up, so I'm going to take that bottom right corner and drag it all the way up. That's going to show my profit loss for the stock, right? If it goes down to 74, I'm going to do 74 minus 100 is negative 26. So we purchase the stock, and then we are going to sell the call. So you know what? Before I do that, let's look at our graph here, and I'm going to filter this. I'm going to select as we go. I'm just going to look at the profit on the stock itself, and that's the stock profit, right? So that's the nice line. I do continuous compounding. That's why it doesn't look perfectly straight. And if you go 10% increments, you're going to see it curve a little more. All right, next, let's look at our profit loss on the call. Now we're selling the call. And when I do options, I like to put it in the money part of it. A call, I'm going to put it, the call contract is in the money. You can see how it works. So we're going to say is equals. Since we sold the call, that's going to be a positive premium we receive. And then that's going to be plus. Remember, we're selling the contract. For the purchaser of the contract, they're going to benefit. They're going to benefit if the price goes up. We're not going to benefit. So what it's going to be the strike price. I'm going to hit function F4 minus the current stock price. So at that point, we're going to be negative $20. And I did not put that function in there yet. This is not going to be correct because when we go out of the money, it will not calculate properly. I'm going to show you what I mean. Oh, I forgot one in absolute reference, and I do this time to time. Again, I'm going to hit function F4 for the premium. and then drag that up. And I just want to show that in the money, we did it correct. Once it is out of the money, this is incorrect. And the reason why it's incorrect when it's out of the money is because if it's out of the money, the purchaser of the call isn't going to exercise his contract. He's not going to take it. There's no reason to. He's only going to do it if the price is above the strike price. So what we have to do, I talked about this in my call lecture. Anytime we sell a contract, we have to do a minimum function, a minimum of that. What does that mean? Is that when it gets here and it looks like I'm making money on the call, I'm not going to make money because the buyer of the contract isn't going to exercise it. So I need the minimum between that function and 0. I'm not going to make any if that's the case. So what I'm going to do is I'm going to take that, go all the way up, and then that's going to be our profit loss. And as you can see, I'm going to lose money if the stock goes up. If I sell the contract, I got to make up that difference. And if the stock does not hit that strike price, I'm going to make the premium, and that's it. I'm going to make that difference of that. So now let's look at what is the covered call strategy profit loss. Actually, before we get to that, let's plug in of our graph. Let's filter and let's put in, we're going to short the call. Let's see what it looks like. So look, that's the stock price, and this is the contract for the call. And as you see, we're making money, strike price going down, break even point, and now we're going to have to pay the difference if the stock keeps on going up. Remember that this x-axis is the stock price as it goes up. So those are the selling the call or shorting the call and purchasing the stock or longing the stock. That's the individuals. Now let's look at what is our profit loss with it combined. I'm going to add those two up. I'm going to go all the way down. Did it once. I'm going to hit Control D. And now, just really quick, I want to look at what is the strategy compared to just owning the stock. You can see the difference. I like to do this to show what it looks like. So that's the covered call strategy minus the difference between just owning the stock. As you see, I'm going to be plus 10. Remember what I said, it's a cushion if the stock price goes down. I'm going to be up 10 more than I would have been if I just owned the stock. Even though I'm losing money, but I'm losing 10 less dollars because I received the premium. All right, let's go back to our graph. And what I'm going to do is I'm going to only do the call, the covered call, and show you what it looks like. So this is the covered call strategy. Actually, to show this a little better, I'm going to show you the profit loss of the stock. I think that will make sense when I put both of those together. So there's our profit loss of stock. So slightly bullish, like it says up here, right? Moderately bullish, expecting a slight price appreciation. Look what's going on. I think it's going to go up a little bit. My strategy is better. I'm paid off more than I would have been up to the strike price. Once the strike price happens, I am capped out of what I can make. That intersection shows where it's equal if you just own the stock or the covered call. And then if the stock goes up any more than that, we are capped out. The stock is making tons of money and we are not making that sort of money. So this graph is really good just to kind of show what it looks like with the actual stock in there as well. There you go. There's a covered call strategy profit loss. Again, it gives you slight cushion if you lose money, and it gives you more money if it slightly appreciates. I believe there's stability to the stock, and it protects me on the downside as a little cushion. So there you go. Any questions, please comment in the comments there, and like this and share this if you find value out of it. Thank you.